Most traders confuse fair value gap with a breakaway gap. The fair value gap is when you have the candle 1, 2, and 3, and candle 3 and candle 1 is not overlapping, leaving this space in a candle number 2. Usually this candle consists of the zeros on the both sides of the buyers and the sellers. When you see zeros or a slightly 0, 1, 0, 2, 0, 3, this is the fair value gap because there's a lack of the fair trades between the buyers and sellers. And there is a breakaway gap when you're seeing that there is a range on the left side and there is a tension created with this candle. This is the smallest candle that is maximum tension of the fight between buyers and sellers, and that tension is released with the breakaway out of the previous range, like over here. So when the tension is released with the strong buyer intentions, what we can see with the bluish numbers that the buyers outweighed significantly sellers, creating imbalance zone. This imbalance zone, it is imbalanced because there is a more, significantly more, about 200 to 300% more of the buyers than the sellers on the left side. So the buyers are outweighed the sellers. So they sending the impulse candle very strongly up. Then we're seeing even larger single imbalances. So this is a stock imbalances creates the zone. And this is a single imbalances 5 to 15, 0 to 10, and even 1 to 27. This is a significant imbalances in this very candle. So we're going even up to the top, and there's some imbalances created a zone, imbalance zone right at the very top. So this candle is a strong impulse. This is a breakaway candle that created after the releasing its tension from previous resistance zone or previous range over here. So while we expect that on the fair value gap, when price is going onto the extension, it may return back and fill out this insufficiency over here when the traders or the orders not traded equally on both sides of the market, on a buyer side and a selling side orders. So the price may come back in a fair value gap, and we can expect the price can come back into the fair value gap. But in this case, this is a breakaway gap, and when the breakaway gap happens, then what we can see that price doesn't have to come back and fill out completely all of that area on the second candle. So usually when the fair value gap, we expecting price to come back and trade, reorder over here, retrade in this area to create the fairness of the trades. But when it happens with the breakaway gap, like over here, we're breaking away from previous range, then the price doesn't have to, and we don't have to expect the price will go and cover that area completely. So now this is the breakaway gap, and the price slightly returned back, and we found that there's not too much sellers existed in all of this testing this area because the previously strong buyers over here proving themselves that they're still sitting in this region. So they're supporting, acting as a support and move the price even higher. And the bottom line is how you can distinguish between the fair value gap and the breakaway gap is by looking at the footprint, because data don't lie. Only by looking at the solid data we can conclude is it a fair value gap or it is a breakaway gap. Numbers don't lie.